5 best investments to earn passive income in 2024. In a world where financial stability and independence are increasingly valued, the pursuit of passive income has become a popular strategy for many investors. Passive income refers to earnings derived from investments with minimal effort or direct involvement, allowing individuals to generate money even while they sleep. In 2024, amidst evolving market conditions and economic trends, several investment avenues stand out as particularly promising for those seeking to build passive income streams. Here are the top 5 investments to consider. Number 5. Real estate investment trusts, REITs. Real estate investment trusts, REITs, represent a convenient and lucrative avenue for investors to participate in the real estate market without the complexities of property management. Functioning as companies that own, operate, or finance income-generating real estate properties, REITs offer a diversified portfolio across various sectors, including residential, commercial, and industrial real estate. This diversification not only spreads risk, but also provides exposure to different segments of the real estate market, thereby enhancing the stability of the investment. One of the primary attractions of investing in REITs is the reliable income stream they offer through regular dividend payments. These dividends are typically derived from the rental income generated by the properties held within the REIT's portfolio. As such, investors can enjoy a steady flow of passive income without the hassle of directly managing tenants, property maintenance, or lease agreements. Moreover, REITs are required by law to distribute a significant portion of their taxable income to shareholders in the form of dividends, making them an attractive option for income-oriented investors seeking reliable cash flow. In addition to providing income, REITs also offer the potential for capital appreciation over the long term. As the underlying real estate properties appreciate in value or generate higher rental income, the value of the REIT's shares may increase, leading to capital gains for investors. This combination of regular dividend payments and potential capital appreciation makes REITs a compelling investment option for both income-seeking investors and those looking to build long-term wealth. Number 4. Dividend-paying stocks. Dividend-paying stocks epitomize the stability and reliability sought after by investors aiming for passive income streams. These stocks signify shares in companies that prioritize rewarding shareholders by distributing a portion of their profits in the form of dividends. Such companies often boast a track record of robust financial performance and consistent earnings generation, making them reliable sources of income for investors. Investing in dividend-paying stocks offers investors the dual benefit of a steady stream of income and the potential for capital growth over time. Unlike bonds or other fixed-income investments that offer predictable but often modest returns, dividend-paying stocks have the advantage of participating in the growth of the underlying company. As these companies prosper and their earnings increase, they typically raise their dividend payouts, providing investors with a growing stream of income. Moreover, the reinvestment of dividends through dividend reinvestment plans, DRIPs, can further enhance the compounding effect, accelerating wealth accumulation over the long term. Additionally, dividend-paying stocks tend to exhibit resilience during market downturns, making them particularly appealing for passive income seekers seeking stability. Companies that consistently pay dividends often have strong balance sheets, diversified revenue streams, and established business models that enable them to weather economic uncertainties more effectively than their non-dividend-paying counterparts. Consequently, dividend stocks can serve as a buffer against market volatility, providing investors with a reliable source of income even in challenging market conditions. Number 3. Peer-to-peer lending. Peer-to-peer P2P lending platforms have revolutionized the investment landscape, providing individuals with a unique opportunity to participate directly in the lending market through online platforms. This alternative investment avenue offers investors the chance to earn attractive returns that often surpass those of traditional fixed-income investments, such as bonds or savings accounts. The appeal of P2P lending lies in its simplicity and accessibility. Investors can browse through a variety of loan listings on P2P lending platforms and choose to fund loans based on their risk preferences, return expectations, and investment objectives. By lending money to individuals or businesses, investors can earn interest income, which serves as the primary source of returns in P2P lending. Moreover, P2P lending platforms typically operate with lower overhead costs compared to traditional financial institutions, allowing them to offer borrowers more competitive interest rates and investors higher returns. This direct lending model bypasses intermediaries, enabling investors to earn a larger share of the interest income generated by the loans. However, it's crucial to recognize that P2P lending carries inherent risks that investors must carefully consider. One of the primary risks is the possibility of borrower defaults, where borrowers fail to repay their loans in full or on time. Economic downturns, changes in borrower financial circumstances, or unexpected events can increase the likelihood of defaults, leading to losses for investors. Additionally, investors face platform risk, which refers to the risk of the P2P lending platform itself becoming insolvent or facing operational challenges. While reputable platforms implement risk management measures and perform due diligence on borrowers, there is always the possibility of platform failure or malfeasance. To mitigate these risks, investors should conduct thorough due diligence before investing in P2P loans and diversify their investments across multiple loans to spread risk. By spreading investments across a diversified portfolio of loans with varying risk profiles, investors can reduce the impact of individual defaults on their overall returns. Number 2, index funds. Index funds represent a cornerstone of passive investing, offering investors a straightforward and cost-effective way to gain exposure to a diversified portfolio of securities. These funds typically track a specific market index, such as the S&P 500 in the United States or the FTSE All-World Index on a global scale. By mirroring the performance of the underlying index funds aim to replicate the returns of the broader market while minimizing costs and complexities associated with active management. One of the key advantages of investing in index funds is the broad market exposure they provide. By holding a diverse range of securities across various sectors and industries, index funds offer investors the opportunity to participate in the growth potential of the entire market. This diversification helps spread risk and reduces the impact of individual stock volatility on the overall portfolio, enhancing stability and resilience. Moreover, index funds offer investors the potential for regular dividend distributions, as many of the underlying securities within the index pay dividends to shareholders. These dividends contribute to the total return of the index fund, providing investors with a steady stream of income over time. Additionally, index funds may also offer the potential for long-term capital appreciation, as the value of the underlying securities appreciates in response to economic growth and market trends. Another notable advantage of index funds is their suitability for passive income strategies. Unlike actively managed funds, which rely on the expertise of fund managers to select and trade securities, index funds follow a passive investment approach. This means that index fund managers seek to replicate the performance of the underlying index rather than actively making investment decisions. As a result, index funds typically have lower management fees and turnover rates, making them cost-effective and efficient vehicles for passive income generation. Furthermore, index funds require minimal ongoing maintenance and oversight, making them suitable for investors seeking a hands-off approach to managing their portfolios. Once an investor has selected an appropriate index fund based on their investment objectives and risk tolerance, they can simply hold the fund for the long term without the need for frequent monitoring or adjustments. Index funds offer investors a compelling combination of broad market exposure, regular income through dividends, and potential for long-term capital appreciation. With their passive investment approach, low costs, and minimal maintenance requirements, index funds are well suited for passive income strategies and can serve as a foundational building block for diversified investment portfolios. Number 1. Rental properties. Investing in rental properties remains a classic strategy for generating passive income and building wealth over the long term. By acquiring residential or commercial properties and renting them out to tenants, investors can earn consistent rental income while potentially benefiting from property appreciation over time. Rental properties offer several advantages, including tax benefits, leverage through mortgage financing, and the ability to diversify one's investment portfolio. However, it's essential to consider the associated costs and responsibilities, such as property management, maintenance, and tenant relations. In conclusion, the pursuit of passive income in 2024 presents a range of opportunities for investors to build wealth and achieve financial independence. Whether through real estate investment trusts, dividend-paying stocks, peer-to-peer lending, index funds, or rental properties, individuals can tailor their investment strategies to align with their goals, risk tolerance, and time horizon. By diversifying across multiple income-generating assets and maintaining a long-term perspective, investors can enhance their chances of success and enjoy the benefits of passive income for years to come. Would you like it? Hit the like button and subscribe to our channels for more interesting and informative videos.